So let us look at the financial and monetary conditions now. The recovery of growth and inflation still depends on favorable financing conditions for all sectors of the economy. Market interest rates have eased over the summer, but reversed recently. Overall, financing conditions for the economy remain favorable. Bank lending rates for firms and households are at historically low levels. Lending to households is holding up, especially for house purchases. The somewhat slower growth of lending to firms is mainly due to the fact that firms are still well-funded because they borrowed heavily in the first wave of the pandemic. They have high cash holdings and are increasingly retaining earnings, which reduces the need for external funding. For larger firms, issuing bonds is an attractive alternative to bank loans. Solid bank balance sheets continue to ensure that sufficient credit is available. However, many firms and households have taken on more debt during the pandemic. A deterioration of the economic outlook could threaten their financial health. This, in turn, would worsen the quality of banks' balance sheets. Policy support remains essential to prevent balance sheet strains and tightening financing conditions from reinforcing each other. In conclusion, the euro area economy is clearly rebounding. However, the speed of the recovery continues to depend on the course of the pandemic and progress with vaccinations. The current rise in inflation is expected to be largely temporary, and underlying price pressures will build up only gradually. The slight improvement in the medium-term inflation outlook and the current level of financing conditions allow favorable financing conditions to be maintained with a moderately lower pace of net asset purchases under the PEP. Our policy measures, including our revised forward guidance on the key ECB interest rates, are key to helping the economy shift to a sustained recovery and ultimately to bringing inflation to our 2% target. We now stand ready to take your questions. Thank you.
Thank you. And today the first question goes to Tom Fairless of the Wall Street Journal. Tom, please.
Hi, thanks very much for taking my question. I had two questions. The first was on the pace, on the discussion around reducing asset purchases. And some of your council members have suggested that they would like to see the PEP program coming to an end soon. Would you characterize this, or did you characterize this internally as a taper, or is it a turning point, or how would you characterize the move? And the second question was around why you feel confident enough to do this. Your 2023 outlook for inflation is 1.5%, which is some way below your medium-term target. There also seems to be a lot of uncertainty in the global economy around Delta, around slowdown in China. So why did you think this was, reducing your stimulus was the correct move? Thank you.
Well, thank you so much for your questions. I would preface my response to your first question by a quote, actually, in a way, which is, "The lady isn't tapering." Because what we are doing is recalibrating PEP, which I remind you is the Pandemic Emergency Purchase Program, and we are recalibrating just as we did back in December and back in March. We're doing that on the basis of the framework, which is a joint assessment. So we look at the financing conditions, and we concluded that they remain favorable. And we do that on the basis on the inflation outlook. And as you rightly pointed out, our inflation outlook has been upgraded, and it has been the case for 21 significantly, 22 quite significantly, and to a lesser extent 23. But across the board, you have an an improvement on the inflation numbers for the whole horizon that we look at. We also look at other indicators, and on those accounts as well, there has been a significant improvement of the inflation numbers, both for 22 and 23. So on the basis of that joint assessment, and because we know that we need to keep favorable financing conditions, this is the commitment that we have, and this is what we agreed in December. That hasn't varied. We believe that we can maintain those favorable financing conditions with a moderately lower pace of purchase. And of course, the choice of words is relevant. It is moderately lower than what we have done in Q2 and Q3. Are we confident enough? Well, you know, the September meeting is conducted in the light of our projections. And what we are seeing is clearly an improvement on many fronts. The output numbers are much higher. The inflation number have been upgraded, as I just indicated. The employment numbers have also been improved, and the unemployment situation is serious, of course, but more benign than was anticipated. So on the basis of all that and the success of the vaccination campaign, which we have all along said was critically important to determine the economic recovery, we believe that the euro area economy is rebounding. And that gives us the confidence to take the measure that we have taken, which, as I said, is a recalibration of our pandemic emergency purchase program for the next 3 months.
Thank you. The next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, over to you, please.
Hello, and thank you for the opportunity, and nice to see you on Webex.
Reciprocated.
President Lagarde, I have 2 questions. My first question is on financing conditions. For how long will the ECB preserve favorable financing conditions to support the recovery also after the COVID crisis? In a sense, will favorable financing conditions end with the end of the pandemic emergency purchase program? And my second question is on PEP. As the coronavirus crisis enters a new phase, as you have described, with the new Delta variant, but also better economic outlook and the good pace of vaccinations, can you tell us a bit more how the Governing Council intends to judge and assess the end of the COVID crisis phase, given that PEP will end when the COVID crisis phase is over? Thank you.
Well, thank you. Thank you very much. And it's very nice to see you as well. This is a significant improvement from previous press conferences. So we're probably heading in the right direction here. Next step will be to actually see each other with appropriate distance between us. On the commitment for favorable financing conditions, I'll remind you that that was decided at our Governing Council meeting in December under the auspices of PEP. So PEP is this emergency program, very specifically designed for the circumstances that we have been facing, that we still face today, but that are currently clearly improving. And this commitment to the favorable financing conditions is one of the 2 parts of the joint assessment that we conduct to determine our pace of purchase. So we have a framework that is very clearly designed and that operates in relation to PEP. And the day when PEP is over, which presumably by then will indicate that financing conditions are favorable and that the economy will have recovered in such a way that the downward impact of the pandemic on our inflation outlook has been resorbed, at that point in time, then job is not finished, because we are still targeting our 2%, which is now clear and straightforward as a result of our strategy review. Symmetric, 2% medium term, with a special focus resulting from the the lower bound. So that will continue. And the driver of our work going forward after PEP will indeed be the mandate that we have to maintain price stability as measured by our target of 2% inflation. On your second question, which has to do with PEP in general, what we have done today with the Governing Council members unanimously is to calibrate our pace of purchase in order to continue to deliver on our goal of favorable financing conditions. We have not discussed what comes next. And this is something for which we will prepare in the months to come. And I think there will be more interesting matters that will be debated in December and for which clearly you will be informed in due course.
Thank you. Next question goes to Alexander Weber of Bloomberg News. Alexander, please. Alexander, can you hear us? Does not.
Yeah.
Go ahead, please.
Here we go. Thank you. Thanks for taking my questions. President Lagarde, some of your colleagues, including Jens Weidmann, have recently emphasized the upside risks to the inflation outlook, and that the higher inflation could prove more permanent than currently expected. Could you tell us whether this view is widely shared within the Governing Council and what the discussion was like at this week's meeting? Then a question on your on monetary stimulus. How much notice will you give markets before the PEP comes to an end?
Sorry, I completely missed your second one. How much what?
How much advance notice will you give markets before the PEP comes to an end?
Okay. Well, thank you for the first question, because I'm going to take advantage of that one to say a few words about inflation and how we conducted our discussion on inflation. Because it is a case that in many countries in the euro area, people are seeing prices increase and they can feel it. So we have to really go under the skin of inflation before we actually assess whether it is temporary, whether it is going to last, and that leads us to the conclusion of our inflation outlook, which, as you know, is 1.5 at the end of the projection horizon. So what do we have at the moment? We have essentially three factors that are driving prices up. The first set of factors have to do with the reopening of the economy. I mean, this is the entire dynamic. It went down massively, and prices, by the way, at the time also went down. The economy reopened, and from a supply point of view, from a demand point of view, of course, there is pressure on prices. You can see that in what we call the base effects. A lot has to do with energy prices, which constitutes a large component of these base effects, inflation factor on inflation. You can see that on the German VAT impact, which obviously will continue to play out until the end of the year. You see that in the carbon tax that was decided also in Germany. So those are the base effects, reopening of the economy related factors. As part of those reopening of the economy factors, I would distinguish the supply bottlenecks effect. And this is something that the corporates and the companies are telling us, are telling you. There are bottlenecks effects, and not just in the semiconductor business, but in all sorts of sectors that are more or less affected depending on how much they rely on those either raw materials or equipment that they get their supply from. And this is impacting the durable and the non-durable goods. Now, how strong will that effect be? How long will it last is something that obviously remains to be seen. And we have put that particular item, if you remember the monetary policy statement that I read for you, we have put that in the inflation analysis, where we say that if those supply bottlenecks last longer than expected, then it will have and it will increase prices and will have an upside pressure. But that we're not certain, because typically what we have seen in previous situations of that nature is that, you know, when you have a bottleneck on your supply, well, you try to find alternatives to that supply, and as a result of that, then the supply bottleneck's impact of inflation is reduced and eventually goes away. In the same vein, if it's bottlenecks inflation that applies without too much on the demand front, it's not necessarily be conducive to second round effect on wages in particular. So that's the third one, the second one, which is a subset of the sort of reopening of the economic consequences. The third one, which is quite interesting as well, which is, especially when you disaggregate it, is the inflation that is related to services. Because we have seen a reopening of the economy on the service front in the most recent month. And when you analyze where the inflation is in that segment of services, you see that most of it is actually coming from what is subject to social distancing, which obviously has been reactivated most recently. So those are the three key drivers of inflation at the moment. But as you can see, many of them are of a temporary nature and will last for a period of time and will then either fall out of the period of reference or will fade out over the course of time. One component that we are addressing, monitoring and checking very attentively is the second round effect, is the impact that price increases will have on wage negotiations. And that is what could actually fuel a more persistent and durable price increase and inflation going forward. On those wages front, we are not seeing much by way of significant increase. We will be very attentive to the autumn negotiations that are typically taking place in some countries, but at this point in time, we don't expect this wage increases and these wage negotiations to be very strong, and we see probably a gradual and moderate increase as a result of that. So that's what I really wanted to try to explain to you in response to your question about inflation. Now, concerning PEP, you know, that's a discussion that we will address comprehensively at our December meeting as the term of PEP approaches. We need to obviously discuss the terms and conditions of how that term occurs, and you will hear me again on this matter, certainly at our December meeting.
Thank you. Next question is for Annette Weisbach of CNBC. Annette, please, for you.
Thank you very much for taking my question. President Lagarde, I have two. One is, if you read through analyst notes, some are a lot less optimistic about 2022 in terms of economic growth. So what makes you so optimistic for 2022? And then also, second question is whether you have ever addressed the risk of a stagflationary environment for the Eurozone, given that inflation, as you also say, could be more persistent, or price pressure could be more persistent. Thank you very much.
Well, on your first question about how confident we are, I observed that since the beginning of the year, we have regularly upgraded our forecast. And if anything, we might have been on the too pessimistic side to begin with. And what I look at more so than analyst notes, which I'm attentive to, of course, is the projections that are produced by staff, how they compare with projections that are produced by other international institutions, such as the IMF, the OECD, and other similar institutions. And we believe that, the economy is going to continue to benefit from further unwinding of containment measures during the second half of 21 into 22 as well. We also make the assumption that bottlenecks will be circumvented by the economic operators in the first half of 22. We believe that we will be back to the pre-pandemic 2019 level at the end of this year, which is 2 quarters earlier than we had initially anticipated. And while we still have a lot of slack, both in production and in unemployment, we are also seeing that slack being resolved and reduced more rapidly than we had anticipated. So that gives us good reasons to believe that 22 is going to be another good solid year. We have not upgraded our forecast for 22. We still are at plus 4.6% in our forecast. And our risk assessment, as I mentioned earlier, are broadly balanced. Clearly, if the pandemic is resolved faster because of even further vaccination coverage, the booster is adopted by many, that is going to be an add-on. If more savings are being used by consumers, that will also support consumption, which has been one of the big drivers of the recovery so far. There's still that chunk of saving that was accumulated over the pandemic period, which has not been tapped into, which might be tapped into. So that's for the upside side of our broadly balanced risk assessment. On the downside, clearly we could have a massive fourth wave or other variants coming to the fore for which vaccinations doesn't work. I mean, you have all these possibilities as well. And the supply bottlenecks, which, as I said, we anticipate will be circumvented in the first half of 22, which could last longer and which would have side effect on inflation and putting pressure up and which would weigh on the GDP on the other hand. I think you had a second one which had to do with stagflation. Our primary mandate is price stability. But we are also keen to see an economy that recovers fully. And for that to happen, of course, jobs have to be created. And the furlough schemes that are in place that retains employees in their position but not in actual employment needs to be pursued. And those 2 million people still more than in 2019 that are unemployed have to also return to employment. So if that is the ultimate response of this recovery, then I don't think that we will be heading towards stagflation.
Thank you. Next question goes to Martin Arnold of the Financial Times. Martin, please. Martin,
hello.
Hello.
Madame Lagarde, can you hear me? Thank you for taking my question. So I have 2 questions. First one is that your chief economist, Philip Lane, said recently that the amount of assets you purchase after PEP finishes will depend on the amount of debt issued by governments. Do you agree? And my second question is about the link between the ending of asset purchases at the ECB and the first interest rate rise. At the moment, there's a close link in your guidance between asset purchases ending and soon after that, interest rates rising. Do you think that there should be potentially more of a gap or more flexibility on that? Thank you very much.
Well, thank you very much, Martin, for this question. It gives me a chance to actually just repeat yet again, because I think it's an important consequences of our last July meeting, the 3 criteria that are applicable for forward guidance on interest rates. And that forward guidance, as you know, has been modified and clarified to a great extent by including 3 criteria. One is we need to see inflation outlook at target, that is at 2%, well ahead of the end of our horizon, first criteria. Second, we need to see it through also to the end of the projection horizon. And second, we need to have sufficient elements and indication of progress in the underlying inflation criteria as at the time when we make the decision. So you have these three criteria, and you have the other element of our forward guidance that remain intact and which actually play a role in signaling to markets when, what will be the sequence of events from asset purchase to interest rate hiking. I think we are pretty far away from that, and it also gives me a chance to remind all of us that PEP is a very specific program intended for the pandemic. It has an emergency character to it, and when that PEP comes to its term, then clearly we have all the other instruments available. And in terms of purchases, we clearly have the asset purchase program, the APP, which we have on a standing basis ever since October 2019. And that clearly is intended to be continued and will be debated, as I said, at our December meeting. So it's entirely premature to evoke it, and it has not been discussed on the occasion of this meeting. Now, clearly, when we determine our pace of purchase, we are attentive to the entire universe of bonds. We are not paying special attention to the fiscal commitment of one country or the other, or the bond issuance of one country or the other. So we look at the entire universe of bonds that are available, will be available, are being announced, and that's how we determine where our purchase pace is going to be applied. But we do so, as I said, based on two things under our joint assessment. One is the favorable financing conditions. The second is the inflation outlook. Thank you.
Thank you very much. And the next question goes to Andres Stumpf of the Spanish daily Expansión. Andres, please.
Hello, good afternoon. Do you hear me?
Yes.
Okay, I have two questions. You said that the need of a PEP recalibration was unanimous. I would like to know if it was also unanimous, the pace decided. And the second question is, after the operation later this month, that would be the only chance, the final chance, there will be only a chance for the banks to borrow money at the long-term tenors and the TLTRO next December. I was wondering if the ECB has taken any decision on this regard, and if there will be any long-term funding operations for the banks, any more operations, I mean.
On your question about the decision that we made today, as I said, it was a unanimous decision in all respects. So the pace of calibration was agreed. The moderately lower determination was agreed unanimously. It was all unanimous. So I'm sorry for those who like to oppose the doves and the hawks. Sorry. For this time, there's not much that you can actually draw from dissenting votes, because we all agreed. TLTROs, you're right. There will be one more operation in December, and we will clearly have to discuss what comes next on the basis of the situation at the time. And I think that will be part of the overall re-examination that we conduct at the time of our December meeting. This will be, as usual, data dependent, and what we have seen based on the bank lending survey, based on the discussions that we've had with representatives of the banking sector, is that TLTROs, certainly the earlier ones, more so than the most recent one, have been critically important to help them and encourage them to provide lending to the economy, which they have consistently done over the course of the last 2 years. Thank you.
Thank you. And the next question goes to Ilias Siakantaris of the Greek TV station ERT, please. Ilias, please.
Yes, can you hear me now?
We can hear you from Greece.
Thank you very much, Wolfgang. Madam President, with the winding down of PEP, a degree of flexibility the ECB has introduced into state bond buying will go away. This is particularly important for Greek bonds as they're not yet in investment grade. Does the Governing Council think that it should be preemptive, clearing out this uncertainty, this lack of flexibility in respect with Greek bonds, and avert unnecessary speculation? Thank you very much.
Well, I think it's really too early and unnecessarily at this stage to discuss, longer-term issues related to PEP and the term of PEP. As I said, it will be discussed at length. We will enter into a process of technical review, in-depth analysis of the situation, and certainly the situation of Greece will be taken into account and addressed specifically. But I think it's premature for the moment to do so.
Thank you. And the next question will then be for Francesco Canepa of Reuters. Francesco, please.
Good afternoon. The first question is about inflation, which was 3% according to a flash estimate. Do you think the balance of risk for inflation has shifted and is now to the upside? And how was this reflected by the discussion of the Governing Council? And the second question is about the fact that many of your colleagues, including Mr. De Guindos standing next to you, have signed letters urging the Commission to implement fully and swiftly the Basel III rules for banks. Your name was conspicuous by its absence. Do you support their call, and including its timing, crucially, because the governor of the Bank of France said the timing of the letter was unfortunate? So I'm keen to hear your view on that. Thank you.
Well, do not worry, Mr. Canepa. There is nothing inconspicuous about my name not being on the letter, because all those matters are addressed by my colleague and friend Andrea Enria, who is, as you know, the head of the SSM. He's the one who has full authority and much deeper understanding of those issues than I do. But I'm not uninterested in Basel III, and I've had my share of Basel III discussions when I was finance minister and when I was then managing director of the IMF. So I do follow these things, and I do believe that there should be proper compliance and respect of the timetable in relation to these Basel III issues. But I will turn to my colleague and friends, the Vice President, who is also very, very close to that. I will address your first issue by quoting, because we discussed this sentence to make sure that we were all unanimously in agreement with that in relation to inflation. And we say very clearly in the risk assessment paragraph, if supply bottlenecks last longer and feed through into higher than anticipated wage rises, price pressures could be more persistent. I don't think we could be more clear than this sentence is.
Now, with respect to the letter, I have not much to add to what you have said, President. Well, the letter was signed by the head of the EBA, by Andrea Enria, and by myself as person responsible for financial stability in the ECB. And, it's crystal clear. The message is crystal clear. We want full implementation of the Basel III. And I think that, that's the position of the three of us, of the three institutions. And as I have said before, we believe that this full implementation, this rapid implementation, will bring a lot of benefits for the banks and for the economy.
Thank you. And the next question goes to Johanna Treek from Politico Europe. Johanna, please.
Thank you very much. Can you hear me?
Yes.
Thank you very much for taking my question. President Lagarde, so when you discuss PEP in December, the economy will have returned, the economic output will have returned to pre-crisis levels. Will that then be a sufficient condition for you to declare the crisis phase over? And then what should we all expect from November? What are you going to do during your November meeting?
What do we do with what?
Your November meeting, given that you are putting so much emphasis on December and
I think
suggesting nothing would happen.
I think it's actually October.
Oh, sorry, October.
Well, we will all get together around the table and we will assess the situation, because not a single monetary policy governing council meeting goes without us looking at the situation, assessing the financing conditions and being attentive to the effectiveness of our measures. So don't worry, I'm sure we'll have plenty to discuss and to review. But as I said, the important meeting at which we will discuss the terms and conditions of the PEP when it comes to its term will be in December. You know, at our December meeting, there will be two things. One is, it could well be that our forecast is actually delivered upon. So we have caught up with the 2 years and we are back to pre-pandemic 2019 situation, which doesn't mean that we are back to trend of the growth trend that we had in 2019. We are still far away from that in our forecast. And we will have new projections, which will give us a projection not for 2023, but for 2024. So we will have more substance to chew on in order to discuss the terms and conditions of the PEP term. Thank you.
Thank you. And the next question goes to Francesco Ninfole of Milano Finanza. Francesco, please.
Thank you and good afternoon. I'd like to ask two questions to President Lagarde. The first, do you fear any kind of contagion from the US in the bond market? And in that sense, will the Fed's decisions on tapering influence your actions? And the second question about fiscal policies. In your opinion, how should fiscal policies be in the coming months? More focused on fiscal consolidation than in the past, or still on supporting economies in an uncertain phase? Thank you.
Well, thank you for your questions. I would preface my answer to your second question with acknowledging that during this crisis, fiscal policy, monetary policy have been reinforcing each other, unlike in previous situation. And the fiscal support that has been extended to all the euro area economies has been critically important. And it has been increased relative to our initial projections. If we look back at what we forecasted in December last year and what has so far been the fiscal impulse and the fiscal stimulus given to the economies, there is a significant difference. It was more than doubled. So fiscal policies have been very important and have supported monetary policy, as I think we have also complemented. So they really worked hand in hand. Our assessment is that the fiscal support has to be continued. And as I said on previous occasions recently, it is no longer the massive necessary support just across the board to all actors of the economy, as was the case in the beginning of the crisis. It needs to be more targeted, it needs to be more surgical, it needs to be associated with the structural reforms that are so much called for and necessary in some countries. And this is really the point about the recovery and resilience plans and the funding that is made available to that effect. That is underway, will continue to be applied in the quarters and years to come in consideration for delivery under the plans, as you know. And we hope that it will facilitate the recovery and it will reduce the risk of divergence between countries and the risk of fragmentation in the recovery process. So a time will come, of course, when this fiscal support will have to be gradually withdrawn and where the rules that the Europeans will give to themselves once they have renegotiated the Growth and Stability Pact, or whatever they call the terms under which they operate, that time will come, but it is still premature, and we believe that a lot of the good results that we are seeing for the economy and the good reason for the recovery has to do also with monetary policy, of course, and we should take full credit for that, and fiscal policies. And this has to be continued because we are much advanced in the process. Recovery has progressed, is rebounding, but we're not there yet. We're not out of the wood. We are not on the green, as the golf players will appreciate. We're getting closer, but we're not there yet.
Thank you. Next question goes to Luke Hayton of Market News International. Luke, please, over to you.
Good afternoon, President Lagarde. Two questions, if I may. The first was whether the Governing Council has discussed the possible impacts a change of government in Germany might have for the ECB's monetary policy. And the second was five-year forward inflation break-evens are at their highest since 2017, about more than 50 basis points since the beginning of the year, way more than the shift in inflation break-evens in the US. How much does such a shift affect your perception of the ECB policy path going forward?
Thank you so much. The answer to your first question is simple and straightforward. The answer is no. We had plenty to discuss, and we did not have any discussion on any change of government in any of the euro area countries, I can assure you. The five-year 1.75% number, which, as you noted, is 50 basis points higher than what it was, which is at the highest in a long time, is something that we pay attention to. But it's not the only one. We look at all the forecast, the market survey, the analyst survey, the forecasters' numbers. We look at all of that. And we also look at what other institutions are producing, because we don't want to be data slave. We are data dependent in our policy determination. But we want to have a look at a whole range of such data to make sure that it's not only directionally in the same vein, but that it's also consistent. And we do look at the five-year, but it's not the only one, I can assure you.
Thank you. And today's last question goes to David McHugh of the Associated Press AP. David, over to you. Thank you. Dave, can you hear us? There seems to be a connection issue, so then the last question goes to Victor Mendes Barriera of Central Banking. Victor, please.
Hi, good afternoon, President Lagarde. My first question is in regards to the self-imposed limits that the ECB has on its monetary policy and asset purchase programs, especially, obviously, the APP. It's true that the ECB sovereign bond holdings have been converging towards the capital key, but if the APP is to be increased, which seems likely once the PEP expires, the ECB holdings would be getting closer to the issuer limit, to the 33% limit on the outstanding debt of individual sovereign countries. Do you deem necessary to increase the issuer limit in order to make ECB QE programs sustainable within ECB rules? And the second question is, whether you had any update on the impact the pandemic is having on the weaker or highly indebted Southern European countries that are more reliant on ECB support, such as Italy and Spain? Thank you.
Well, on your first question, thank you very much. But those are issues that will be debated in December. So it's not a matter for me to debate the exact limits in any shape or form, or the capital keys. All I know is that we have a mandate, we have an objective, we have a target which is to be reached, and we will have to use all the instruments that we have available. And we will decide on what terms and conditions will apply at our next meeting, and we will adjust accordingly if necessary. On your other point, you know, what I observe is that those nations that were most affected by the pandemic, which are largely countries from the south of Europe, are the ones that are benefiting from the highest volumes of loans and grants under the Next Generation EU. And we very much hope that with the plans that they have submitted, which have been approved, with the loans and the grants that are already being disbursed and will continue to be so if there is delivery in consideration, then they will be in a much better position to respond to the damage that was suffered. What we can observe, though, is that in relation to tourism, in relation to hospitality services, there has been a significant increase in activity, and probably more so than was expected earlier in our projections. Thank you very much.
Thank you. This concludes today's press conference. If you want, we will see each other back on 28 October when the next Governing Council plus press conference takes place. Until then, wish you all the best, goodbye, and have a good afternoon.